I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show.
Good afternoon, sir.
Danielle, do we have a de facto trade war between the U.S. and China?
Sure. We have a lot of posturing going on, a lot of, standing up for principles right now. I think that it's understandable considering that there's a shrinking pie of spending going on in the world, so the exports of most countries are falling, and so there's less revenue to spread around the world. And of course, each country is in the midst of its own debt-induced crisis, crunch of cash flows. So you really have, trying to take strong positions, which may appeal to, the electorate in some countries with this protectionist notion of protecting jobs at home, etc. But there's no question, and you can argue that that's an essential part of every long-term cycle where the pendulum swings from massive globalization, which is what we had, back to more protectionist policies to try and reinvigorate job growth and wage pressure in the individual countries. So all that's quite legitimate, but the reality is that, everyone is dependent on exports in this environment, and exports have been falling, and the global growth trend, the global GDP, has been falling now over the past couple of quarters. It really peaked around the spring of 2017, so actually about a year ago. And so we're seeing that as growth turns down, as less money is being spent, the funding crisis gets more intense, and the pressure on politicians to make a show of doing something intensifies.
I think the ultimate expression of that showing you're doing something was the Falklands War between Argentina and Britain over the Falklands Islands. The Argentinian economy was in horrible shape, so what better way to distract people but a war?
Well, this has been, from Henry VIII and long before that. It's definitely a common ploy of politicians to divert attention. So in other words, the things that are wrong at home are hard to fix, right? They're massive. You have to do long-term strategic thinking. You have to invest. You have to defer gratification in many cases, defer spending in order to, build up reserves for the future. And of course, there's little patience or appetite in that, increasingly so in recent history. And so as a result, those things are unpalatable for many people. And so politicians like to try and divert and distract. And I'd have to say that this administration, the Trump administration in the U.S. has been brilliant at diverting and distracting. Like all of the media, most people watching are really focused on everything that's irrelevant while the big issues are going largely missed.
We'll have more with Danielle Park right after the break.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
Welcome back. We're speaking with Danielle Park. Danielle, if the equity markets do crash here, what kind of opportunities would people have then?
Well, I think it's important to make a complete distinction, Jim, between I know that crash is a word that people like to use, and it may or may not be suitable for the declines that are normal in these cycles, but a 50% correction is normal when you have the obscene valuations that we have presently in the world with the incredible leverage and debt levels. So a 50% decline or correction is a typical bear market in this environment. Now, if you say that to some people, they say, well, you mean a crash. Okay, fine. If you think of that as a crash, I see that as a normal mean reversion period after the spectacular overshoot to the upside that we've seen in so many of these indicators over the past few years. So basically, as we saw in this secular bear cycle that began in March of 2000 from the peak of the all-time peak of valuations at that point, the tech bubble, this is a lot of similarities to today, really. The cycle then was led by a handful of tech companies that really overinflated the indexes. Remember, Nortel was an enormous portion of the TSX at that time, Jim, and as it went up, the TSX went up in leaps and bounds. But then the reality is that those assets are insanely overvalued, and they can never perform or deliver the expectations that are built in at those prices. And so we've seen in the last couple of months, for example, a real souring of the appetite or the image of these high-tech companies, the FANGs in particular, the Facebook, Amazon, Apple, Google, those companies that were the high flyers that were really tearing the market up to the upside in the last couple of years have really come under a lot of negative sentiment and scrutiny, and indeed things like Facebook's down 18% and Amazon's down about 10%, and Netflix is down about 11%, and Alphabet, the parent of Google, is down about 14%. So you see that these high flyers, Tesla, although I love the cars, I would not have bought the shares at anything close to these levels in the past few years. They're down about 22%. So what you'd see is there was this blind faith in those tech companies as if they were going to solve all the world's problems. And so people were paying insane multiples for their earnings, and in some cases for negative earnings. All of the IPOs that have come out, Jim, in the last couple of years, 70% of them have actually had negative earnings. So no earnings. And people have been paying insane multiples, talk about overpaying. I mean, paying for zero earnings, an incredible multiple. So what that was typical of the tech wreck as well in 2000 when people were just a little bit higher than that. I think that it peaked out at about 80% of the IPOs that were brought out at that time had negative earnings, and people were gobbling them up thinking that they were, winning the lottery somehow in grabbing these things. Nothing to do with investing, nothing to do with rational numbers, all to do with speculation and hopes that you're going to win somehow. So we've seen that as the dominant trend. And like I say, that was always going to be a point where the jubilance or optimism, blind faith was going to be broken, and that may indeed have started as it should and as it must. And then that diverts people's attention. Not only does that have a disproportionate impact on the indices because they've become so heavily weighted and dependent upon these, this handful of companies, but what happens is that then people start looking at, once the bubble of optimism bursts, and they start looking at the more tangible factors, let's say, in terms of the world, in terms of wage growth, in terms of debt to equity levels, in terms of, as I say, GDP. For example, when you talk about the trade issues, before we even got into this significant trade war that's just coming into into the mainstream now. We already had, for example, negative GDP growth in Canada in January, for example, of 2018, and South Korea already had a contraction in its GDP in the fourth quarter of 2017, even amidst all the pomp and circumstance of hosting the Olympics. Actually, both countries are almost equivalent in size. The GDP of Canada and South Korea are close to 1.5 trillion. So similar size, not a huge portion of the world economy by any stretch, but the reality is that we are sort of canaries in the coal mine, if you will, because Canada's 27% of our GDP comes from exports. We saw the data this morning, wider trade deficits in both America and Canada because of weaker exports. So I think that's a theme that may indeed be with us for the next year or so. And if that is the case, you're going to see a backing up of expectations about rate hikes from the Federal Reserve and from the Bank of Canada. I think, as I say, they were talking brave talk while they thought that the global economy was firing ahead, but the evidence is just not there to support that. And, at some point they're going to have to blink. And then, although they've made some progress in hiking rates, they still have very little meat on that bone when it comes to cutting again to re-stimulate spending. And with consumer and businesses already at the top end of their ability to service the debt that they already have, even if rates don't go higher, I think that you're into this negative feedback loop of disappointment on spending capacity, and that means we're certainly overdue for a recession, but all of this sort of stacks the odds of that happening, in the next year or so, greater and greater. And so, as you ask about opportunity, clearly there's opportunity on the other side of this. It's going to be significant. Not only will it be cyclical, like it was in the lows of 2003 and the lows of 2009, but potentially this could be a secular low, which means the final low of this period where the mean reversion finally brings valuations back down to below the average. We're far, far above average right now. We're, like twice the average price to earnings ratio as an example. So the secular bears typically end with the opposite direction. In other words, the valuations well below average. And if that's the case, then obviously dividend yields will be 3 and 4 times higher than they are right now. If you're buying the same income stream, but you're paying half as much for the asset, you're going to be richly rewarded in terms of the income and a much more stable capital base, which is the really critical thing here, Jim. I don't know if you caught, there was a study that came out. I had put it on the blog, but it was looking at the health impacts of wealth shocks late in life. And this is something that I think is very little, is just not enough discussed, is, all of the talk about trying to, whip your savings like a dog team and make it go faster and buying these financial products. But people don't realize that as they get older in life, having a big decline in your net worth, not only is it, difficult for your finances and often promotes people having to change their life or go back to work or work more and longer than they'd anticipated, but they've actually found a connection to one's physical health and how, when you have this kind of a wealth shock, you actually die sooner and have a much less quality of existence thereafter if it happens to you late in life. So this is the reason why people have to be so cautious right now. If they're, the demographic trend of the aging baby boomers has lined up perfectly with them entering their 50s, 60s, and 70s with the bulk of their life savings coming to the end of their working career, and the debt super cycle has lined up with, a good deal of them still having debt where, 30 years ago, 70% of the people that were in their 70s had zero debt, and today it's like, about 56% of people in their 70s have zero debt. So there's a lot more debt being carried a lot later in life. Not only that, the savings that people do have, they have been herded into these incredibly overvalued assets, whether it be real estate, whether it be in securities markets. And this is why, you're really lining these two trends up at the worst possible time for this group of people, because they are, hoping that their asset side will continue to appreciate when the odds are incredibly stacked against that, and mostly stacked against the best case scenario being a flat return over the next decade and more, and a more negative scenario, which is actually quite probable in this case, which is that you get a massive decline and then it takes 10, 20 years to recover prices to current levels. And I know that seems impossible for people to comprehend, but if they did any historical study or looking at these trends of secular cycles over time, they would realize that that's actually the norm, not some asteroid hitting us from outer space. And so that's why, there won't be enough time to make back losses if you allow yourself to not be prepared for this in advance, but kind of go over Niagara Falls with everybody else and then have to spend the next many years trying to climb your way back up the cliff. It's just going to be horrifying in so many ways. So that's why it's very important that people try and be proactive.
We'll have more with Danielle Park right after this.
Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp. Inc., MGI on the TSX Venture Exchange. A 2015 drill program on the LH property intersected high-grade gold, including 16.9 meters of 13.58 grams and 11 meters of 20.66 grams per ton gold. A follow-up drill program is planned to further evaluate previously identified subsurface high-grade gold mineralization. Please visit our website at magnumgoldcorp.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Danielle Park. Danielle, you mentioned before the break that people should be more proactive right now. What should they be doing?
So to be proactive means that you have to, if you have a bunch of assets which are not producing income or are a net drag on your cash flow, now is the time to think of downsizing them rather than after, when everybody is increasingly doing so. We've already seen a turning over in the Canadian real estate market. Jim, as you may be aware, sales volume has been plunging, certainly in Ontario, and prices in many areas, including the one I live in north of Toronto, are already down. The average sale price is already down just over 20% year over year. So we know that sales volume precedes price by several months, but ultimately typically follows that trend. So the people that are overhoused or have many properties or have been taking these crazy, home and garden television training programs, courses that tell you how to lever up your house and buy a bunch of rental properties, now would be the time to look at downsizing your risk and leverage there, as sooner the better, rather than waiting to have to do it with the herd when everyone's trying to liquidate together. So that's one way they could be prepared. The second way is to try and revamp their budget now so that they are spending less, wasting less, so that they have more buffer, more, shock absorber, so to speak. Another way is to figure out ways to increase your income. Sometimes that may mean converting surplus space, for example, into rental apartments in your basement, or in some other property that you may currently be holding, which is not producing an income right now. And the other thing is that you need to reduce the security market risk in your savings. Your savings, your liquid pool of money that you have taken out of your business and employment endeavors over many, many decades of your life, and now it's sort of your pot that you have to support, that has to support you through your retirement. You cannot allow it to be exposed to massive drawdowns. This is the point I was talking about before the break. And that does mean that you have to look at scaling back equity exposure, corporate debt exposure, securities that typically move in tandem during these periods of downturn. If you are sitting there fully loaded on that going into this period, you are going to be traumatized, but not only that, you are not going to be able to take advantage of buying things after they have come down in price again, when everyone's looking for liquidity and when it is a buyer's market. Right now, We're still, although we've had some correction, the markets have had the worst quarter. First quarter of 2008 was the worst quarter in equity markets since 1929, excuse me, Jim. So, it has been a bad start to the year, but still the mean reversion that's accomplished to date has been tiny, minuscule in relative to what is in process to complete this secular period. So I think that is the next thing, is people have to look at trying to downsize their security risk now and realize that most financial advisors never advise anyone to do that. They always talk about buying opportunities. They never talk about selling opportunities. So in many cases, in most cases, people have to be looking out for themselves and trying to, as I say, take proactive steps that doesn't just involve, losing a ton and then waiting years for it to recover.
Danielle, thank you so much for chatting with us.
Thank you, Jim.
Our guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.